Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host today. I'm joined by David Bodamer, and he is the investment editor with wealthmanagement.com. David, thank you for joining me.
Thank you for having me.
I'm excited about this conversation. I get tons of different articles from tons of different sources every day. I struggle to keep up with all the reading. You're one of the news feeds that I end up reading, but I can't read it all.
Right.
So tell me more about your current role and what you're seeing these days.
So, like you said, I'm the investments editor with wealthmanagement.com. Wealthmanagement.com, for folks who may not have heard of us, we primarily have an audience of the advisor world. So our RIAs, IBDs, wirehouse, all that's the universe of our audience. So the investments coverage that I am in charge of is about just looking at the whole spectrum of what are the trends around how the wealth channel is investing in various things. So that can be very mundane stuff just around are you risk on, risk off, like what's your overall bonds to equities. But increasingly, it's also about alternatives, whether you should be including them, how you should be including them, what are the benefits they offer, what are some of the pain points. So that increases. So we've just done a lot of coverage this year, just given the emergence of so many new products, the real experimentation, I think, on both sides, and the real opportunity set that I think folks see here, that historically alts are underutilized in this channel, so they can provide benefits that you may be missing from a more traditional 60-40 portfolio. So really seeing how this is all going to shape out over the next decade, I think it's just going to be such a fascinating thing for me to be tracking.
Yeah. Is anybody still endorsing the 60-40 portfolio?
I think somebody at one point was like, it's bloodied but not dead. but I think increasingly, I think a lot of discussion around that it's too simplistic just to think about a 60-40 portfolio anyway, because you're right. Actually, if you're talking to different clients, they're going to be in different places in their lives and different objectives. And, that's a blunt instrument of just doing that is not really appropriate anymore anyway.
Yeah, completely agree. So let's focus in on alts. What are you seeing the latest trends with advisors right now?
So I think the biggest thing is really a lot of, I think you look either at a couple of ways, because there's the bigger firms and there's smaller firms, right, within the advisor universe. And some of the bigger firms, I think, are further along because they've got larger investment committees in-house. They've done a lot of due diligence themselves. They may use third-party platforms as well, but they also just have a lot of direct relationships with sponsors and have already, to some extent, been offering alts to their client, to appropriate clients for years. And I think they've used a lot of the structures that have been around much longer, like traditional drawdown structures. They're comfortable with that, maybe because some of their client base is also qualified purchasers and the like, who you can put in those kind of things. I think then smaller RIAs may not be doing anything. And then also you do have this question of okay, once you get lowered down into the wealth channel, down into the accredited investor level, and into this mass affluent, these were clients that in the past you wouldn't have really thought about alt as a product or as a solution for them, but now you can be thinking about that. But how do you do it? So I just feel like there's just this process right now of education, looking for best practices, getting the heads around what alt/private assets means, and starting to really implement. I think you do see a pretty steady stream of from the folks that track it, of a lot of flows from this channel coming into alt products, and it really being used.
So something that I've seen evolving trend is all these different structures now kind of meet the needs from the QP down to the mass affluent. Right. And some of them are diversified portfolios, which eliminates some of the single asset risk and makes it more palatable depending on the investment objective, education, and experience of those investors.
Right.
You do a lot of talking with advisors about a whole, broad range of topics. When it comes to alts, what do they like in alternative investments? What are the key benefits or outcomes they're trying to achieve with alts?
I think the biggest thing that we hear a lot is the increased diversification. We went through the experience of, I guess, 2022 when that 60/40 portfolio had the really aberrational year, but it also maybe made people realize that even if that we're not going to have every year like that, just the idea these things are more correlated than we thought they were. So actually the introduction of something that is less correlated has certain benefits. It also, I think, it comes down to these client discussions, I think, that we've referenced as well. The idea of if you're looking for income, if you're looking for certain protections, there are different alts products that can fit in and really achieve something that really aligns with what your client's goals are. So I think they're just finding use cases for real assets, for private credit, and I think they have different applications. If it just applies to we're trying to generate some extra income, or if we're trying to do diversification, or if we're doing some long-term planning, just depending on what the specific role is. I just think the idea of having additional tools in your toolkit that you can bring to a client, and maybe not every client needs to use it, but at least they know it's there,
right?
And then you can actually apply these properly.
Well, and I like the alts because yes, you get some lower correlation because they're not traded. In addition to the asset classes are performing differently than other asset classes, so you get additional asset classes, but then you have this added component of I'll say stability, but lower volatility because it's non-traded. And it's performing more on fundamentals than any technical movements in the market.
Right.
So since there's a lot of positive movement towards alts, any challenges or obstacles that you're seeing advisors?
Yeah, I think a few things come to mind. One, again, thinking about the small advisor, this could be a lot to learn, right? Alts is a lot of different, we tend to talk about it as alts or private assets, but obviously we're talking about, real estate, private credit, private equity, infrastructure, other even more esoteric real assets that people are discussing at this conference. That it was just sitting with somebody who's doing a solar panel thing. So that's, very niche. So yeah, but even within real estate, right, where you're talking about 6 or 7 or 8 different property types. So it's just even if you want to get into real estate, you have to know what you're doing. So I think it could be very daunting from the jump, just, the number of different flavors of private assets, but then also the number of different fund structures you have to become aware of. So I think that's one initial barrier, I feel for a lot of RIAs, is just taking a step into this is you have to learn about a bunch of stuff all at once. And I think a lot of folks seem to be really focused on also providing that education now. Groups like ADISA, but also Kaya, associations like that. Even the asset managers themselves, I feel every single asset manager now, you go to their website and it's they have an alt university, right?
Yeah, it's fantastic. So, there's a lot of great content out there.
So people, and then even the third party platforms or marketplaces offer their own. So I think there are people trying to provide that education, but I think it is still a lot to figure out where to know where to start. The other obstacle that I think pain point that we hear a lot is just the idea of, okay, even when you get into these things, how is the way that you're managing or looking at your alternative investment interface with your other investment management platforms? So
sure, all the operational components.
Yeah. So is it fully integrated? I think people would love the idea of just having a dashboard where they could see everything at once. And I don't know if we're fully there yet, but I think there's a lot of attempts to try to integrate stuff on the back end. And just in general, making the whole life cycle management of alternative investments a more painless process, so that the subscription, easing the subscription process, easing the reporting process. Some of these, it's not technological, but even the way that you design the products themselves, some of these products that have a simplified tax structure, that's a benefit. All these so like there's a bunch of potential friction areas. So then how you address those friction areas, I think, is like where a lot of attention is being paid in terms of addressing some of these obstacles.
As it should be. And there is some very innovative companies that are out there that are competing, rolling out different technologies and trying to provide good solutions. So it's something to watch and pay attention to. But I 100% agree with both of those pain points, but they're being worked on. They're known, and people are trying to tackle them.
Exactly. I think that's a very important point.
There's lots of dialogue also between asset managers and financial advisors.
Right.
Financial advisors saying we want this, asset managers trying to figure that out. Where are you seeing those two things converge?
You're seeing it around like how these newer products are being designed to me. Like, so the and I mean, some of these are not brand new structures, they've been around, but there's no question we're seeing a much higher use of things like interval funds, right?
Oh yeah. The growth rate of launching interval funds is huge right now.
Yeah. That seems to be part of and part and parcel of that seems to be like, okay, here's a structure that the minimums are lower, the subscription process can be easier. We're going to give you a 1099, right? There's no increased capital calls. It's just like you buy this and then you're in it, and then it does have the periodic liquidity, like 5%, I think a quarter for an interval fund. Tender offer funds have a little more leeway about when they have to go to the market and offer those liquidity windows. I think we're also seeing an interesting interplay of aligning specific assets with specific structures. That's kind of an interesting subplot here. Like interval funds seem to be, and private credit seem to be getting along really well.
Yeah, absolutely.
As a way to do it. But I mean, there's some real estate in interval funds too, but we've always had the non-traded REITs as your kind of default way to do real estate in these limited liquidity vehicles, private equity and BDCs. So there's this interesting, and I think, so that the one way that they're, I think, converging is on this these products, which are supposed to be easier to use specifically for this audience. And then I think the other thing is just from the asset manager RIA relationship. There's a lot of RIAs who I think have a general sense that they don't want to have too many manager relationships. I think from the asset manager's perspective, some of them what they're trying to do is become a one-stop shop where they have a full menu of all of these things, or a bunch of different product types, a bunch of different assets, as a well built out menu as possible, because they know that RIAs or other advisors, in an ideal world, want to have a fairly narrow set of relationships with asset managers. So I think that's another kind of way that this is playing out. And you're seeing from the asset manager's perspective, either folks that are building out pretty big menus themselves, or forming some joint ventures to address holes that may be in their existing menu, or buying other folks. Right? There's a lot of consolidation even on the asset manager side, so that folks can buy in maybe a specialized alternative manager to now have under their bigger umbrella, rather than building a business from the ground up.
Yes, I completely agree. And I'm also seeing financial advisors try to be tracking, 1 to 3 asset managers per sector or asset class, right? They may have their go-to, they want to back up, but, then there may be another option, because some managers are great for a period of time and then they fall off for one reason or another. Right. And so RIAs are great about tracking performance there. So, they need to have that in reserve and not just start from scratch,
right?
And be more dynamic. The other thing that I'm seeing, and I want to see if you agree with this or not, is that the tender funds, interval funds, the NAV REITs, and the BDCs, they're checking all the boxes for the RIAs, right? So they're providing that liquidity they need for active management, to kind of check that box that they are justified in charging that fee. But then they're also giving that NAV, so they know that they're billing the right amount for that client. So I think that now that these structures are out there, we should see a lot more adoption. Would you agree?
I would agree, and I think the industry stats back that up. I mean, like Stanger, which doesn't even track tender offers, but they track the other ones. Their numbers are that we're going to be at 115 billion in funds raised in the non-traded REITs and the interval funds and the BDCs that they track. So they're not even capturing the whole universe, because I think there's other data providers who do track the tender offers, and there's they have another bucket of money. So 115 billion just in these three, then you add in whatever the tender funds are getting, and that's going to be a record year. We know that. So I think you're also, the fact that you're seeing actually more entities even paying attention to this, like Morningstar put out a whole giant report on interval funds a few months ago, and they're figuring out how to rate these things among their fund universe, and they're looking at the other categories as well of these limited liquidity. So I think having also like third-party entities that people trust, like Morningstar, like giving some insight, is another thing that could get RAs comfortable with these. Like if you have
agreed,
if you have ways to assess them yourselves, because they have a lot of filings, right? I mean, these are 40 Act funds. There's a lot of documentation you can just drill down yourself. It's not like a black box. But then you also have increasingly third-party entities that you might trust rating these things, and rating them in a similar way that they rate a mutual fund. I think that's pretty key to adoption. Like if folks understand that it's different, but if they at least are thinking in the same language, that these are rated funds the same way that I'm looking at a rated mutual fund, maybe that helps. That also helps grease the wheels of implementation.
No, absolutely it will. So in wrapping up, trends that you're expecting to see in 2025?
Yeah, so I think just seeing the race here around, I think some companies have first mover advantage and are clearly enjoying a lot of flows, but you're also seeing some other really big names coming in. So just seeing how this plays out, where does the money flow to? That's one of the big things. But also just the increased innovation, and I'm really interested by. BlackRock recently unveiled an idea of doing an alts SMA, which would provide access to. They're going to create a bucket. They created a partnership with. I'm forgetting if it's Partners Group or Capital Group. I'm sorry. So one of those is correct, but because those two, just for their names are so generic, but obviously they do some amazing things, and they're big and they're huge players. So they're combining with one of those, creating an SMA that's going to provide access to existing limited liquidity vehicles. So you can just buy into an SMA that's already a little bit diversified. So if you just want to have this alts exposure, this is another solution now, where you could just buy into this SMA. You're automatically going to get some real estate, some private credit, some private equity, and you're getting it from a couple of really brand name sponsors. So that's an interesting solution. Then the other thing is this potential behemoth of the private ETFs, right? That we're seeing all this sudden buzz around it, but even within that, we're looking at three things that are being called private ETFs, because you have the ones that are taking the BDCs or investing in the underlying companies. You have the ones that are investing in collateralized loan obligations, and those things. I think those two models exist in some form or another. People can get their head around. But then the Apollo State Street idea of the ETF directly owning underlying illiquid assets, that's the one that's is the SEC even going to go for this? And then if they do, is it going to work? Are people going to buy it? And if they do, does this suddenly create a whole new way to do this all? So that's a really big thing that I think is going to be interesting to watch in next year.
That's one thing I love about this country, the constant push for innovation, to be creative, to meet client needs. So David, thank you for taking the time out to share, your perspective from being the editor there, right from the news desk, and reading this stuff all day long. Really appreciate it.
Well, thank you for the opportunity. Enjoyed the conversation.
Yes. And thank you for watching another episode of Focus on Alternatives. Again, for more information like this, please visit adisa.org. Thank you.